Alright, hello everyone. So today, I'm gonna make a video about Saudi Arabia. For a bull and bear case, I actually did some research during when the Gulf War was happening, and it's still happening. So it could be a little bit outdated, but not too much. A little bit outdated in terms of the price, but everything else should be relatively not too big of a change because this research I did is just about a week ago, so it's not too old. So there's actually four stocks that I'm looking at in Saudi Arabia, and they're exchanged for Tadawul. Tadawul, not the best pronunciation, but trying my best. So it's basically framed around 2026 during the Iran war, with focusing on geopolitics and their vision for 2030. That's the case study that I'm focusing at for my research. So there's four companies, a single exchange. There's 1.4% for the drawdown during the Gulf War. And just a fun fact, the USD, I mean the Saudi Arabia currency, it is pegged to the US currency for 3.75. Alright, so before getting the video started, I'm not a financial advisor. This video is just for entertainment and educational purposes. Always do your own research before investing. So, geopolitics. Why did Saudi Arabia stocks actually held? I was actually kind of shocked when I found that out during the research. Well, when I was looking at the graph, it was shock, but I guess it kind of makes sense in a way. So there's 4 points. So geography, infrastructure, and they have a 930 billion sovereignty fund. That's backstop. 900 around 930, but it keeps on changing. Yeah. So one of them is they have two coasts. One is the Red Sea, and the other one's Hormuz. And Hormuz is the one that is the most well known of right now, the last 2 months. Red Sea, it was quite popular and on the news with with the pirates and stuff. That was like 2020, like three. So not as much you hear right now, but Hormuz is definitely the big topic right now, the last 2 months. So they actually do have a pipeline that's 1.2K kilometers from east to west. It delivers around 7 million barrels a day. It is unaffected by the blockade, but is not really enough. 7 million is really not enough given the demand that goes out, for everyone in the globe. So it's not enough. And I think the price point is very obvious that it's not enough. And not just like Saudi Arabia, everybody who's affected in the Gulf definitely makes a huge impact. And Saudi Arabia just one of them. Number two, the institution buyers. So Saudi institutions, they actually turned as a net buyers during the war with PIF, Public Investment Fund, plus domestic buyers, kind of cushion off the sell off, and the foreigners, like for me example, in the future, you know, all the sell off is being bought by local buyers, during in the local citizens, so it kind of helped out ease off the price, and the exchange obviously didn't really have a price difference. It actually went positive compared to the neighbors they have, like UAE, Qatar. So it was kind of surprised when I found out during the research. The third is oil sensitivity. So Aramco holds around 12 to 16% of their stock exchange. You know, it's just around there. So when the price of oil spiked around 200, $120, obviously like every oil company right now is being rallied 3 to 4% that time. It made the index higher while the other Gulf markets fell. Like I just said earlier, Qatar and UAE, they're not doing that well compared to Saudi right now. And lastly, they have a 496 billion in reserve as of March 2026. So, foreign reserves defends the, 3.75 RIA that's pegged to the US dollar. So for foreign investors, it's really zero risk right now on Saudi equities. And just a fun fact, Tadawul closed the first war week in a positive, you know, week somehow, but their neighbors weren't doing so well. So the Dubai actually fell 17%. So it doesn't look that good for them as of right now. So Saudi held, and the neighbors didn't. So as you can see in this graph, you know, they were barely positive, so it's only a 1%, and there's an 18 point spread compared to Dubai's market. So it's negative 17%. But as of right now, they obviously recover a little bit, but they haven't fully recovered prior to the war yet, based on the recording that I'm doing right now. So Vision 2030. So what is it? So it's a multi-year thesis, and the money and the caveat. So the first one it is a 930 billion public investment fund that's being driven for Vision 2030. It is 2 trillion. One of them is 2 trillion projecting mega project, the pipeline. The Neo, that's the biggest project that, everybody know of. You know, biggest that everybody know of. And the Red Sea, I think some people do know about it, but the last two, I don't think that many people know about it. I just know the first two, but the last two, I don't know anything about it, but it is part of the project. So for 2034, the FIFA World Cup, that will be that's going to be hosted in Saudi Arabia. So that'll definitely be a big boost. So this is going to be the same thing. I believe it's going to follow the same method as Qatar. So prior to the World Cup in 2022, there wasn't that many tourism. But because of the World Cup, they have more exposure. Obviously with live broadcast, fans who were going to the stadium, they got a huge insight. It's maybe a culture shock too, learning something new, which, after 2022, Qatar tourism has been going up ever since. But not right now because, the war going on right now, but it's only been going up. So that'll definitely be a good boost for them. It's a great investment. It doesn't take a brain to figure that out, so it's a great investment. So the caveats. So to scale back, the Neo line is actually being paused as of September 2025. I didn't know about it until I did the research. I didn't remember listening about it, but I didn't know it was true. I didn't bother to fact check it because that's not important enough for me to go take a look into it. But actually, it's actually being scaled back as I did my research a week ago. So, like, it's pretty obvious, but these mega projects is it's not as a huge priority as of right now because the oil revenue is not as stable compared to any other sector. Oil is actually very volatile compared to the other portfolios that they have in Saudi Arabia. But it is still the main one, the main revenue driven for the country and for the government. So construction hit. So during the war week, there was a lot of news. Obviously not just Saudi Arabia, Qatar, UAE, they were all hit. They were all hit, but the level of exposure it varies by these three countries. But for Saudi Arabia, one that's 11%, 12%, and 10%. Real estate and mining is definitely the most exposed one. Uh, is not really that good, but in a way, it is good for them in a way. For if you look financially, it's good for them. They will definitely see some more business during the upcoming build up. So it's not that good to hear, but if we're talking about facts, But yeah, they're gonna do well in the upcoming few months or few years. Lastly, oil dependency. So Vision 2030 is definitely funded by oil revenue, the main revenue driven for Saudi Arabia. So it's kind of hard to sustain, it's kind of hard to plan out, because oil prices is very volatile. So it's very hard to like plan all of these. And actually, during when they were talking about the Neo line, that was definitely when the oil was not cheap. That that was like a little bit after during the peak of the Ukraine and Russian war. So the price was quite volatile. So and the price of oil back then is a lot different compared to right now, prior to the war. So it's kind of hard to project how long it will take and how much resources they'll need to put into those mega projects for Vision 2030. All right, so for Saudi Aramco, I think that's kind of given. They're the uh, biggest holder for Tadawul. Their ticker symbol is 2222. I really like that number. So it's a 5.8% dividend yield. Their net profit for 2025 is 348 billion, but is Saudi Arabia's currency. For 5 years, their dividend growth is only about 2.9%. Their payout ratio is 92%. So there's pros and cons to it. So the pro is it is the largest dividend payer. It distributed about 85 billion in 2025. Their free cash flow consistently above 100 billion annually, and their operation for oil is dirt cheap and profitable even at weak prices. I actually saw a video maybe about a month or 2 months ago. I found out about like the cost of oil is like really dirt cheap. It's like less than $10 US dollar per barrel that costs to produce. Like there because geographically is different. Also, they have like really light sweet oils that everybody really wants. I think it's less than I believe it's less than $10, but I see a lot of like videos about it. Some could be right, some could be wrong, but I really believe it could be like below like $10. I believe like 6 or 8 maybe. 'Cause I saw so many videos about it, but I don't know which one's actually true. But I didn't really fact check about it because there's a lot of different sources. But it's definitely below $10 per barrel, so it's really cheap. Oil price spike expanded. Realized per barrel is great for them, especially right now. Uh, and given that it is central to Vision 2030 spending, uh, you know, as of right now, but it will change in the upcoming months or a year or so. So the bear case. So it is 92% payout ratio. It really leaves little cushion if the oil softens, which it will definitely happen because it is a very volatile market. For the 5 year dividend growth, it's only 2%. So it is just yield. It's not even just growth. So it's not that good at all. So compared to other stocks. So revenue and EPS forecast declines 5% per year on demand transition. It is a very concentrated risk in one commodity and one geography, which we can tell right now during the Gulf War. And as renewable energy, adoption comes more and more throughout globally. Energy transition remains a long run structural headwind for Saudi Aramco. For the performance, I was actually kind of shocked. So as you can see, these are the numbers. I was kind of shocked, but these are really the performance for Saudi Aramco. So this is one of Saudi Arabia's bank. I'm not gonna bother to pronounce it because I can't, but it looks like a very good stock, and you can kind of tell the returns that it's showing right now. So on 5-year return, it is a 95.7%. 5-year dividend growth, 18.9%, 18.7%. Payout ratio, 37%. Their net profit is 18.2 billion. So the pro is, it is the largest Islamic bank by market cap as of right now. The 5-year dividend growth rate of 19% per year is really rare for a big bank. It has a low payout ratio, 37%, leaves room for continued dividend hikes, which they do. Vision 2030, mortgage and retail credit tailwinds, 12% net profit growth in 2025 with strong loan book quality, which I think that will definitely help. Not in a good, not in an ethical way, but with the war, it will definitely help out. For the bear case, so it is trading at 17x of their earnings, price for continuing growth, Saudi mortgage exposure concentrating in real estate and rate risk, which, the war going on, it's kind of iffy, but it's really iffy right now. Just really matter when, to be honest. Rising global rates, pressure net interest margin. There's no foreign exchange diversification. It's just per, RIAs and Gulf cycle exposure. The dividend is semi-annual and historically uneven. So as you see here, the performance right now is not that good because of the war. So down 7%, 6 months down 10%, but 1 year up 5% and 5 years year 96. So it's still doing pretty good. So Saudi Telecom company, the dividend yield is 4.1%. Their DPS half, you know, 0.50. Oh, my throat. The 3 years EPS growth is 7.5% per year. Forecast ROE 15%. So the bull case is, consistently correlated dividend. They are one of the most reliable in Tadawul. The 5G rollout and fiber broadband drive durable for growth. I think that really goes out for any telecom companies, for any countries. So it is a very stable stock compared to other stocks like Aramco. They have a dominant market share. It is a very high switching cost, which really equals to defensive cash flow. They are expanding digital services, like cloud, fintech, data centers. They are backed by, PIF, Public Investment Fund. So the bear case is they have a heavy capex for 5G pressure free cash flow near term. Price comparison from mobility and Zen KSA and mobile. Political risk, pricing and spectrum rules set by regulators, those are not predictable, but it will happen. The yield is kind of average, so it's about like 4%, so it's pretty average. As you can see, the performance, it is a very safe, stable, slow growth, but not something you have to worry about it too much. Again, this is one of the utility companies. Utilities are kind of, should and known to be stable and shouldn't really expect, high growth compared to like bank or tech per se. Saudi National Bank. So their dividend yield is 8.7%. Their PE ratio is 9.4. Market PE 20.4. The coverage, they're pretty well covered. The bull case, they have the highest yield among major Saudi banks. They have the largest bank in Kingdom by assets. They're kind of like too big to fail status. They are trading at a very big PE discount. The dividend is well covered by current earnings as of right now. and they're the key financier for Vision 2030. The name kind of says it there, Saudi National Bank. So it pretty much just sells it there. So the bad thing about it is, like I said earlier, uh, the 2030 is not looking so good right now, especially the mega projects. So they're very exposed to the Neo one, Neo and the Line, which is not doing good right now. Whenever that thing will return is we really don't know when. Analysts expect the share price to decline through 2026. With the Iran war, definitely makes an impact. Oil price volatility, that will definitely make an impact as of right now. But not too much because oil is doing good for them right now, at least for the oil prices. But not just oil prices. What about you know, the infrastructure hits and stuff? So those will definitely, take some time to, build back up, go back to the way it was pre-war. So it'll have a big impact. It's an 8.7% yield, can flag as a value trap if earnings slip. So it'll be really interesting to find out when the next earning call happens to see their financial statements and their EPS. So the performance wise is down recently, but over the 5-year course, it is up, but just only 22%. So they're definitely, kind of pressured off during the war with the sell off, All right, so 5 years of four very different rides. So Aramco is down, Telecom's up, banking is up, banking is always up. So that's something that I always look at because banks is there to make money. So it's very hard for a bank to lose money unless they make like a really bad decision. But if you're going to the largest bank, it's kind of really hard to fail. But for the performance wise, those definitely something that you can sleep, better at night for, but it's not something to worry about too much. Again, bank is there to make money. All right, so four of them is actually in a very different category. So if you want, chasing dividends, that would be a Ramco, 5.8%. They're a winner right now. It is a slow dividend growth, but really unmatched cash flow on the Tadawul weight exposure and oil sensitivity. The chem powder, the bank, 19% year dividend growth, 96% 5-year return. Their price for growth is 17x, best for quality in the basket, highest rating risk if the growth slows. The defensive one is, the telecom is really reliable quarterly dividend, low beta, held during the war as of right now, won't shoot the lights out, but provides stability and cash flow. The value play, 8.7% yield, 9.4 price to earning ratio. Cheap for a reason. The Neo exposure in the swing is a huge factor right now. It is a very high reward if the 2030 vision accelerates. But, that'll definitely take a few months. Maybe, based on what I can think right now, I believe at least it'll take half a year or maybe a little bit over a year to fully recover uh, for the Gulf nations, and especially for Saudi Arabia. Lastly, again, what I share today is not financial advice. This is just something I do for fun. You know, do your own due diligence, consult with a licensed financial advisor before making any investment decisions. All right, thanks. Bye.